Welcome back. You're watching Business Morning on Channels Television, and we're continuing our conversation looking at the foreign exchange market and matters arising. I've been having a conversation with the Assistant Vice President and Head Research and Intelligence of BGL PLC, Mr. Femi Ademola, and Mr. Wale Abe, who is the Executive Secretary, Financial Markets Dealers Association. Both gentlemen are still here with me in the studio. Thank you so much for staying with me. Well, let's continue our conversation. And I know that I said when we come back, we'll look at possibly a fusing of the three segments of the foreign exchange market, so that there is a single foreign exchange market. I know that Mr. Ademola has mentioned that maybe we should have a devaluation, but that might not come in the short term, maybe in the medium to long term post-election. But would this be a good avenue for the central bank to be looking at right now, Mr. Abe?
Well, my fear is that how do you achieve that? But unfortunately, I mean, the closer the three rates are, the better, because what that does is that speculators are eliminated from the market if you're able to achieve that. The wider it is, then the more incentive you give speculators, to come into the market. But it is the truth is that the gap has widened, and as long as I think the benchmark, international benchmark, is about 5%. Once you have that percentage higher than 5, then you encourage speculators to come into the market, because they can. What it does, it promotes round tripping. So. The challenge is how do you achieve that? But like he said, one option is to look, where is the market now? And then you decide to move to where the market is. And because which one pulls the other? Is it the official now, or the BDCs and the parallel market? And so these are the things that we need to take a look at.
Mr. Ademola.
Let me repeat again. When I say devalued currency, what I'm just saying is, like you said, move with the market. The market is already there anyway. So people will say, it's too much. But we are there already. In interbank, which is probably the largest of the market.
But then in the short term, you cannot devalue the naira. The central bank cannot devalue the naira, because we have, of course, election matters already. So
okay, that's the point. The CBN is supposed to be independent. The MPC is supposed to be independent, regardless of whether the election or not. So
but did you not want to heat up the policy any further?
There's nothing about eating up the policy, and that's the problem. If we are truly, really independent, like we are talking about, it shouldn't matter. The most important thing is safety of the economy first. Economic stability, that's what. If we devalue, there are two things that it helps. Number one, it helps us to safeguard our foreign reserve, right? And we won't have the hemorrhaging of it, because we have to be using the money to defend at any point in time. The market will see how it will move on its own, and then this unnecessary demand will just calm down. We save that to the benefit of the macroeconomy. Again, it encourages export. We spoke about a situation where we need to make Nigeria more productive, send things out, and then make sure that we have exportation rather than importation. It helps us, because now a little dollar translates into better naira for you, and then you, the local producer, will be encouraged to do that more. Another one, it discourages import, really of non-essential matters that we can source locally. Some raw material that we import, maybe there are local alternative for them, we can do it. Some drinks that we drink that are imported, there are local alternative we can drink and we find. Some clothes we wear. So what I'm saying is that it has its benefit. Yes, it immediately we could probably be thinking of the effect. Medical tourism would be more expensive. Even all the vacation, the kind of travel will be more expensive. Yes, but to the greater good of the economy, everything is fine. People will not be happy, because of people that usually, do things like that to be expensive, then might not be able to pass the cost to people almost immediately. But then, hey, should we say because of elections coming, we're not going to make the country because the way it's going on, the next 6 weeks or 8 weeks that we're waiting for the election to take place, we don't know where the dollar will be. Already, I was made to understand that in foreign contract, $4 is already trading at 255 to naira. I mean, to a dollar, naira to a dollar. I mean, that's not too good. So if we adjust it quickly, the better for us. Yes, because of the austerity implication of it, it might affect the outcome of the election, because of going, but hey, that's what it is. Over time, we will try to understand how the two have to be separated, and there won't be any need to say whatever happened at the MPC has affected the polity to that extent. That's one. Two, about what is there about the market coming together. I think we have something similar to that before. I don't know how we want to do that one and say, okay, this is just one single market, except we are floating, so that CBN is not involved in it anymore. If we float and CBN doesn't have to defend anything anymore, then we know that about whatever you source from, whatever you can source it from, and everything will be fine. It will be easier that way. But at a point in time, we have the liberalized market, where the rates are close together. The BDC, this official, they were close together around 120 naira thereabout for a very long time, and that was because at that time we have high amount of, high value of foreign reserve. We have good SS code account that we have, so people see us having capacity to defend, and even the CBN itself was able to give enough supply to the BDC. I think they are selling up to 100,000 to 400,000 per week to them. So there was supply of the, so it doesn't really put a lot of things in. And then there were some reforms that were taking place locally that people are seeing opportunity to export. We are determining a lot of things, but lately it seems as if we are turned around again. So we are more import oriented again, and then unfortunately for us, we are not able to have savings again because of the loss in revenue that will have accrued to the federal government. They now have to be using the reserves, as in the SS code account, to be supplementing revenue because of the losses, pipeline foundation theft, and all stuff like that. If we are able to cover those parts, then it will be okay for us to have good revenue, to have some savings that people can. Again, we talk about perception. The market is seeing us as not having the capacity to continue to defend the naira no matter what.
Mr. Abe, you wanted to add something?
Yeah, I was just saying that the circumstances that we are in is unusual. And then when you have this kind of unusual circumstances, then you need to take some unusual, decisions. What I possibly want to see more is a situation whereby the trade policy, which is part of the fiscal policy side of the part of the fiscal policy side. I think it is high time we took some actions about now. There's a need for greater harmony, in terms of policy between the monetary side and then the fiscal side, especially in terms of trade policy, which he mentioned actually. Either you like it or not, you can't just, as at now, just drive through the streets, especially in the congested areas. A lot of things that are coming into the country, even when we say there is, the exchange rate is high. So we have to do some unusual things, and that is just the truth. Well, it's election time, but either we like it or not, it is about Nigeria and the economy at the end of the day. If care is not taken, we may just have to sacrifice more.
Now, talking about unusual things, I know that BGL brought us a recent survey on the research on the market, and it was suggested that there should be a systematic weakening of the exchange rate. Could you talk more about that?
Yeah, again, it's exactly the same thing we're talking about devaluation, that we should weaken the exchange rate in such a way that we're able to have more naira from a little amount of dollars. What we have done is to look at the situation of the oil price and see the effect it has on our budget. In the first instance, the budget right now, even at $65 that we have right now, the scenario is showing that we can't even get to that, because right now oil price is below $60, and the agreement of analysts worldwide is that the new normal seems to be an average of not more than $60 going forward in a very long term self. Because right now, we said that shale oil can be affected, it costs between $40 to $60. So any price above $60 make it profitable for shale oil gas to come on board. And if shale oil come on board, it increases glut, and then since the demand is fixed anyway, it's even reducing globally because economy is slowing down in China and like of India, and therefore everybody is trying to slow down in demand. So what it means is that the fundamental in oil price has changed, and therefore the era of oil price of $100 per barrel is not likely to be seen in a short to medium term. And therefore, we need to adjust our budget. Even at $65 per barrel, we still have, and adjusted for the borrowing of $570 billion that's in the budget, we still have a gap of up to $200 billion to cover. Now that we are not even sure of getting oil price up to that $65, what it means is that we will need more money. So, and we can say that the gap will be covered by borrowing, because already, as at the borrowing we have, the debt stock we have up to the end of 2014, in 2015, the budget is accounting for about a quarter of it for debt servicing. that means that we are going to be using about a quarter of the budget to service the debt we've already borrowed before. So if we borrow more, it increases the cost of servicing. Locally, debt is too expensive because it has to be MPR 13% plus something for it to be so expensive. Even foreign borrowing has become even more expensive now because of the fluctuation in the exchange rate. Because even if you borrow at 5% or 4% foreign borrowing, and now the exchange rate has done more than 15% or 16% devaluation lately, what it means is that you've already had a cost of more than 17-20%. So both ways, debt is expensive for us now. Therefore, the immediate easy way to be for us to devalue. If you devalue the currency to, like, say, 185 or 195 naira to a dollar, we get more earnings in naira, and that can cover the fiscal gap. So our scenario in a situation where we can have oil price at different price scenario, and look at it that our budget benchmark should be better put at 55 and then exchange it at 195, and then we will be able to cover the gap or the fiscal for in interim. Another thing we suggested again is to bring down interest rate. Now, bringing down interest rates will be able to help. I mean, once you bring down interest rate and devalue the currency, the implication can actually be matched, and therefore there won't be so much problem in that regard again. And then interest rate could now help most of those local companies to produce products that can substitute for the import that will be affected from this one, and therefore we can export some of these things and get earnings, and then we'll be able to increase our productive base to be able to make us competitive enough to probably regain some of the lost thing that we have in the naira, like he said, that over time. So it's a work hand in hand with the fiscal authority and the money policy. I said that one. The issue of the reforms have to take place. Interest rate and exchange rate devaluation will have to take place from the monetary angle, and then helping the other area in terms of trade policy and everything have to happen from the fiscal authority for it to match. And that is what we are suggesting as the way out, at least in this 2015, for the fiscal gap that we have.
Okay, so for you, Mr. Abe, in the short term, what further interventions do you think the central bank can do at the moment?
I mean, to be candid, I'm not too sure that we even want to suggest any short-term measure. Given the level of uncertainty, I mean, as a result of shifting of the election by another 6 weeks or so, there is very little that can be done, to convince anybody. However, what is even more important to me is that I would have loved a situation whereby the major political parties are debating, not the kind of debate they were planning and was aborted. To debate, they've come up with what we call their manifestos, and each party has been making promises. However, this is the time to actually challenge them and say, look, given the situation and the circumstances that we are in today, each of those political parties, what kind of policy options do they have? And then how do they hope to even respond, to all these developments? And then, of course, how do they, whatever promises they are making, how do they hope to fund, those items in there? And those are more important than any other thing, and I think we've seen.
All right. Well, thank you so much, gentlemen, for joining me on the program and sharing your thoughts with us. It's been an interesting conversation. Femi Ademola is the Assistant Vice President and Head Research and Intelligence of BGL PLC, and Wale Abe is the Executive Secretary of FMDA. Will both gentlemen share their thoughts on latest matters arising at the foreign exchange market. But of course, if you missed out today's program, you can catch up on it on youtube.com/channelsweb/videos and leave your comments. And let's continue this conversation after now. But I'm Harriet Tagbinyi. Thank you for watching.